We're bringing in Danielle DeMarco. She is our real estate investment mortgage specialist. She doesn't just put you into a mortgage on every investment property. She develops a real estate investment plan for you so that you can buy one property after another, and each successive property doesn't affect the mortgage that you're going to get on the next one. So Danielle, if you want to come on in, we can, let me just change this here. There we go. We can turn the seminar over to Danielle, and Danielle, by all means, take it away.
Perfect. Do you by chance have those slides for me?
Yes, I do.
Fabulous. If you could start those up, that'd be great. And thank you for the introduction. So I've been working alongside Tim and Azad for a very, very long time, some 15 some years now, but investment financing is a little bit of a different type of beast when we're talking about financing. It's not just, hey, what term do you want? What rate do you want? It's, hey, what are your plans for this property, the next few properties? How do we set up a successful environment for multiple mortgages and using multiple lenders in the right order, in the right timing, to basically, accumulate multiple properties. So what I wanted to talk about today is, on par with what Tim and Azad have been talking about. And this is, mostly related to existing property owners, and how you can set up your mortgages to help pay off debt, help increase profit, things like that. Tim, can you flip me to the next slide, please, if you don't mind? Thank you. So refinancing. When you own a property, refinancing is the process of either redoing your mortgage and taking existing equity out, so equity you've built up in that property, or it could be extending out amortizations. So maybe you started off on 25 years, you've paid your mortgage for 5 years, you have 20 years left, but we want to extend it back out to 30 years. Changing mortgage terms, things like interest rates, open, closed, variable, fixed. We can change all of those terms. Debt pay down. So that's a big part of refinancing. A lot of people will refinance to consolidate debt. You heard Tim and Azad mention earlier, they had a client who sold the property to consolidate and pay off debt. So there's both of those options, selling, but refinancing allows you to retain that home for those of you that want to continue to invest and keep that property, and lowering payments. So this is where, we're talking about increasing profit. Next slide. So just to give you guys kind of an idea and an example of what something looks like. So this is a refinance to reduce debt. So we are in a time right now where rates are higher, consumer debt is higher, payments just seem overwhelming and never ending. So if you own your own home, accessing the equity in your home is a good way to deal with that debt. So give you an example. You have a home value of $500,000. Let's say you owe $275,000 right now, and your payment's $1,850 a month. You have a penalty to break the mortgage. Maybe we're going to break it and refinance it midterm instead of waiting until the end of the term. And we have a lawyer cost to do so. But you have a credit card of $15,000, a second credit card of $20,000, and a personal loan, let's say, that comes to $650 a month. Maybe that's a car loan, maybe it's a personal loan. That's maybe your current financial situation. If we take that property and we refinance it and we access some of that equity and pull it out to put you in a better situation, we have that same home worth $500,000. We're going to take a new mortgage of $330,000 to consolidate all of the above. And your new mortgage payment is going to be $1,985 a month because we put you out over 30 years. Your old total payments were over $3,500 a month. Your new payments are less than $2,000. You're talking about over $1,500 a month in savings. So when we're talking about this in the realm of just reducing debt, imagine what you could do with $1,500 of disposable income every month that now is no longer going to pay these higher interest credit cards or loan debts, but is now consolidated into the mortgage. And so sometimes we as investors or just homeowners need to kind of change the way we think about our home. And, some people have the goal, I want to pay my mortgage down as fast as possible. But at the same time, this is your equity. It is your money that's sitting in your home. Feel free to access it and use it. Reducing debt can put you in a better situation that then allows you to potentially purchase that next property, which is then now we're investing. So yes, we've used a portion of your equity to pay down debt, but we've put you in an overall better financial situation to continue on your investing journey. And next slide, please, Tim. So this next example here is refinancing to qualify. So that's kind of what I was just touching base and leading into, is when we're trying to qualify for a mortgage, we have to take into consideration all of your debt. And the banks and the lenders have debt ratios. They have a GDS ratio, a TDS ratio. The TDS ratio is your total debt, and that takes into consideration everything, including outside payments on credit cards, personal loans, things like that. So let's say your current situation, same thing, $500,000 home, $275,000 mortgage. We're going to break it early, have the lawyer fee to do so. We've got the 2 credit cards and the personal loan. If you're a family household making $150,000 of income, if you kept your financial situation as is and did not refinance, you could purchase a property for $200,000 with 5% down. That's it, making $150,000 versus flip to the second situation where we refinanced to pay down some debt. We take that new $330,000 mortgage that we consolidated at the new $1,985 a month. And now that same $150,000 household income can get you a purchase price of $350,000 with 5% down. So just by consolidating that debt, you've now allowed yourself $150,000 more in purchasing power on the next property. So think about that for a second. And we haven't even accessed debt or access refinancing. We haven't even increased the loan amount to potentially take out down payment. So let's say maybe if you're in the situation, the current financial situation, you don't have a ton of savings. Well, we could take that mortgage of $330,000. We could increase it up to $400,000, which is 80% of the property value, which is what you're allowed to refinance to in Canada. And now let's save a mortgage of $400,000. You needed $330,000 to pay off all the debt, redo your mortgage. That leaves you $70,000 sitting there of your own money that you can now put toward a down payment on the next home also. So refinancing for debt pay down, refinancing to qualify, refinancing to access your equity out to purchase the next property are all interrelated. We can do one of them at a time. We can do all of them at the same time. We can pick and choose depending again on each person's individual situation and what's right for them. And next slide. So refinance for profit. This is another one. Let's say we're talking about a rental property and you've got a tenant. So again, same thing, $500,000 house, mortgage balance, $275,000, but you're coming up for renewal. And this is a situation that most people are going to find themselves in this year, next year, year after, and even this last year. For those of us that had 1.5% to 3.5%, even high threes, you're going to get sticker shock when it comes to interest rates when you come up for renewal. So this person has this house worth $500,000, $275,000 balance owing at renewal, and they have 15 years left on their mortgage. So they've had it for 10 years. Their payment is $1,500 and change a month. Their rate's 3.29, and their starting amortization was 25 years, and they're making $1,750 a month in rent. If they just renewed, so let's say the lender sends them a renewal form that says, hey, we're going to renew you at today's rate of around 6.09, sign on the dotted line and check the box, and that's it. If they were to take that, their payment would jump to $322 a month instead of $1,565 a month. Their rental income is $1,750 a month. They are no longer not only not cash flowing, but they are negative quite a bit on a monthly basis. So let's redo the mortgage. We're coming up for renewal. Let's think about things and restructure. That same $500,000 home, $275,000 mortgage. Let's not touch it. Let's not pull out equity. We don't need to refinance. Let's say we have down payment for the next home. We're not in a situation where we need to consolidate debt. We just want to get our property back from being upside down. Well, we can keep that $275,000 mortgage the same, but just choose to extend that amortization out over 30 years. So we get that same interest rate that you were going to be offered by the bank, or even lower in most cases, actually. Now your new payment's $1,652. So you went and saved yourself, instead of $2,322, you're $1,652. So you're about $600 a month savings. Yes, you extended your amortization out. Yes, it's going to take you a little bit longer to pay down the mortgage, but you're not really paying down the mortgage. That $1,652 a month is covered by the $1,750 a month of rental income. So you now have this investment property that's still sitting there. Yeah, it's going to take you a little bit longer to pay it off, but your tenant is still paying it off. you're still cash flowing on a monthly basis and or breaking even by the time you factor in taxes and such. And you're not supplementing the property and in a negative profit situation, negative cash flow situation on a monthly basis. So this is a strategy that we're using, not even just on rentals, but on owner occupied homes. For people who are coming up for renewal, you sign on the dotted line. Yes, you've paid your balance down, but the amount of time you have left in the mortgage has decreased on the amortization side of things. Rates have drastically increased. That combination of a shorter amortization and higher rates far outweighs any pay down that you've had over those 5 years or 3 years, whatever term you had. Your payment is going to be increasing. So it's good to be looking at these different strategies, because let's say we do this on your owner occupied home. Again, that goes to refinancing for qualifying. Now we might be able to qualify for a bigger house or a better rental property for the next property down the road. So us looking at your overall investment portfolio doesn't necessarily mean we're only going to look at what's coming up next. Part of my job is to also look at what you've done in the past, how you've structured things. Do we need to change anything and restructure anything to better set you up to accumulate additional properties for the future to keep that investing going? Next slide, Tim. So that's it. I just kind of wanted to touch base. You know, Tim and Azad seminar tonight is about, you know, profits and debt pay downs and kind of getting your finances under control. And this is a great way to utilize an asset that you own for either profit, qualifying, you know, consolidation, you name it.
Awesome, Danielle. So a couple of questions in the chat. If anyone else has got questions for Danielle, please put it in there. So first one from Alex. Alex has a couple, but I'll give you the first one. How favorable do the existing lenders, will they extend amortization? So I guess how favorable will they do that? And do you have any objections from the lenders when you go to extend that?
Yeah, so amortizations, basically the key word here is refinancing. Anytime you use the word refinance, you have to remember that we have to follow the rules of refinancing. In Canada, that means that you must not exceed 80% of your property value. And that's kind of the biggest thing. Second thing is you do have to re-qualify to refinance. So if you're going to sign on the dotted line on a renewal form, you're not allowed to change any of the terms of your mortgage. It has to be the same exact remaining balance, the same exact remaining amortization. You can't make any adjustments. So typically when we're doing a change in amortization, we're usually switching lenders, even lowering and getting a better rate than the current lenders typically offering you. And we just have to make sure we ask, honestly, there's 6-7 questions that we kind of ask up front to determine, is a refinance possible? So again, like I mentioned before, whether it's extending an amortization or pulling out equity or restructuring, whatever it is, all of those fall under that refinance category. So big number one, property value. You have to have at least 20% equity in the property value, which is why right now we're seeing a lot of restructuring, because as you saw Tim and Azad mention, house prices are not slowing down. Values are not slowing down. Your neighbor's house, the higher that they sell for, obviously the higher the value your house is. The higher the value your house is, the easier it is to refinance and the more equity we can pull out, or the easier it is to extend that amortization. So really it just comes down to numbers. As long as we qualify to do a refinance, then extending an amortization out to 30 years is just math. It's just do the numbers work. We don't have objections from lenders on extending out amortizations. The only time you would get an objection is if you tried to do it midterm without a penalty and go to the bank and renegotiate the terms of your mortgage. They would say no, because that's, you know, a refinance, you're actually breaking your existing mortgage.
Yeah, so for everybody out there, I just want to stress, don't feel bad if you need to go down this road. Like we look at investment properties and we look at clients' investment properties all the time to work out, well, what is the best situation? We've got one girl, Joanne, who owns in Tuscany, and she bought for $450. The mortgage is down to $300, but that term at 2.6% is coming up at the end of the year, and it's going to jump all the way. Daniel, what's today's rate? It's going to jump up to 5.5%. Maybe
Depending
more
on her down payment, et cetera. Yeah, kind of that 5.5 to just over 6%, depending.
So for Joanne's situation, I mean, this is a joint venture partner of mine. So I could tell you guys for this situation, if we want to hold on to the property, she may look at just refinancing the 300K, spreading it out over 30 years. It drops the payment way down, and then the rents are going to go up. I mean, the rents right now, we've got a tenant for another year at 2,000, and current rents in that area are 3,000. So if you can make the numbers work, then that is a possibility. And don't think, oh, well, you know what, I've got another 30 years to pay this off now. It doesn't really work like that if you're an investor. You could buy some more assets, you could take money, refinance those assets later on to pay off this property, because the mortgage is still going to be 300 and below. So I need to stress that point. And I think it was Alex, he had another good question, because people are wondering, Danielle, really, do I get into a fixed? Do I get into a variable? I know with Tim and I, we always will take the gamble. There was a period this year that was saying, oh, you've got to do fixed. But now we feel that, I don't know if we hit the ceiling, Tim, but now we feel that the interest rates, they can't go much higher, and they should have dropped already, but people keep spending money. And Tim tells me that during COVID, people stored up so much money that they just keep spending it now, and we need that money to run out before inflation settles and before interest rates will drop. How long will that take? We don't know, but it's a gamble. Do you do variable? Will it go up a few more points? Will it start to go down? We don't know.
Yeah, what's your opinion on, say, an investor gets in the market, should they go variable or fixed right now, Danielle?
A loaded question, because it depends. If you're doing a flip, variable, right? Or an open, totally different. You don't want a penalty. You want the lowest penalty possible. A flip is a short-term investment. You're not planning on holding on to it for a very, very long time. If it's a 5, 10, 15-year property, that's where we need to weigh the options at the time of purchasing, because right now rates are literally changing daily. We are getting emails, 10 p.m. Mountain Standard Time, rates are going up at this lender. Then the next lender comes in, or then the next lender the next day. So it's an ever-changing, rental rates are higher than owner-occupied rates. So when you're talking about variable on an owner-occupied, you might be, 6.8%-ish. But on a rental, you're going to be well above 7%. So you need to kind of decide, okay, if I take a 5-year fixed on a rental at, let's say 6.14, if rates don't come down for 3 years, are they going to come down enough to offset me having paid 7.5% for the first 3 years? Or do I take the 6.25 or 6.14% for the first 3 years, knowing that, yeah, rates are going to come down and I might miss a bit of a downward swing, but are they going to come down 2% to offset the extra percent plus that I was paying for the first 3 years? So you got to weigh it out, and it is a gamble. What?
Yeah, it's a gamble. I believe it's a wash. I mean, it's a gamble.
It could be.
But you know what? The answer is, Alex, the answer is, if you're more comfortable knowing what that payment's going to be, then go for it. Fix it in. I mean, there's nothing wrong with that.
Yeah.
I had people fixing it in. I've got JV partners that were fixing in 4 years ago, and I'm like, whoa, that's a bit crazy. And the interest rates did drop below that. Like, we had some at 3% and they dropped down to 2.5%. And I thought, oh, I wish we weren't on a variable. I wish we weren't fixed. But now look at us. We're like rock stars, right? So
yeah,
it's
I can't tell you. I've had so many people, so many emails over the last probably 4 or 5 months. I can't, like, this payment's just too high, and they were all on variable. So it really depends where we're at in the market right now. You're not going to see a ton of shock when it comes to variable. We might see another 1/4 point increase, but probably not more than that. So really, your payments that they're going to be at now, if you take a variable, you're kind of near the top end. People who took a variable 2 years ago, they just experienced 4% of increases. They're panicking and freaking out because they should have locked in. But now, if you're taking the variable, you know what you're getting into, you know where it's at, and you know there might be a slight increase, but not a ton. So you can kind of account for, okay, if it goes up a 1/4 point, am I still comfortable with that payment? Do I like the flexibility of the variable and being able to break the mortgage? So that is all pieces of the conversation that we have when we're trying to decide, okay, what is the best interest rate for you and what is the best term? Every person's different. Every property is different. And it's funny because sometimes, like Tim and Azad, you can attest to this, but sometimes we'll get a client that says, okay, I'm looking for a single family home that's got a legal basement suite. And then all of a sudden they go out house hunting with Tim and Azad and they do a 180 and they're buying something totally different than they thought. Well, now the rate and the term that we talked about is probably going to be entirely different because their strategy may have changed. So your strategy on that specific property is also going to determine, do we do fixed, variable, shorter, longer, all of that stuff.
Yeah. First of all, the property should be cash flowing no matter what. And you should be living your life. Like these interest rates and inflation, I mean, we're going through it right now. I'm going through it right now in restructuring because you know what? I don't want to be pinched down with these rising costs. So I would rather, and we're going to get into all of this, Tim, refinance or sell a property so I can still go on vacations or do whatever I want to do. Just quickly, Danielle, someone had a question about asset-based lending. I mean, it would have to be commercial at the end of the day, and then they still put personal guarantees on anything that we're buying that is commercial anyway.
Yeah, so there, what you call asset-based, sometimes we refer is as net worth lending. So there are net worth lending programs. They are very strict though. So to give you an example, the most basic net worth program that's out there, you have to have $250,000 of liquid assets in addition to over and above your down payment. Never mind if you don't qualify, we also have to count for every dollar that you don't qualify for of that mortgage. We have to have another $1 in liquid assets over and above that 250,000. So you do have to have a really decent amount of liquid assets and not tied up in real estate. Like they when they say liquid, they mean liquid. So there is programs out there, but they're quite strict and they are very liquid asset reliant. Personal credit, always. So when you're buying a personal residence or a rental property, it's an application in your personal name and your personal credit is pulled. Even if you open a corporation and purchase a property in a corporation, you still have to give the personal guarantee. Your name is still on the mortgage, personally guaranteeing it, and your credit is still being pulled personally. And then commercial, as Azad touched on this. So how commercial works is, and it's a whole nother beast, so I'm just going to high level it, but with commercial, they really are mostly focusing on the property itself, the cash flowing, the financials, DCR ratios, things like that. But yes, you do still have to give a personal guarantee. And funny enough, anybody that's giving you down payment on that property or anybody that's on the corporation that's buying that property also has to give a personal guarantee. So Canada is very heavily reliant on personal credit.
Awesome, Danielle. That's awesome. So if you need to contact Danielle, her details are there. As Tim said, Danielle doesn't just get you a mortgage. What do you say, Tim?
She creates a real estate plan so that you can buy multiple properties over time.
Yeah, Danielle's
Thanks,
awesome.
guys.
We've worked with her for over 16 years. Give her a buzz, write down her number. Totally worth it.